This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app. Neil Dutta is an optimist. He's head of U.S. economic research at Renaissance Macro Research. He's absolutely nailed the better than good American economy. Neil, I got to go to GDP first, and then Lisa and I want to dive into this inflation report. And the basic idea, Neil, is Atlanta GDP sees a sprightly initial start to the quarter. Are you at a 3% run rate on a real GDP, or are you at a lesser run rate?
Well, I mean, remember, it's still very early in the quarter, and the Atlanta Fed tends to get, that estimate tends to get better over time as more data comes in. But even if you assume, a typical kind of, error term, and like, let's say it's all going down, you'd still be talking about above trend growth. So it'd be really hard for me to see, GDP coming in something below, 2.5%. when the quarter's all said and done. There's just a lot of momentum behind the economy, right? So when you hold things like the level of consumer spending flat to where it was in June, you're still talking about a build-in for the third quarter from consumption of over 1% at an annual rate. So I think that's primarily what's driving the GDP Now estimate. But look, I mean, the economy is growing above trend. Your own Bloomberg consensus sees GDP, I think, barely 0.5% in the third quarter, negative in the fourth quarter. I think that is highly unlikely, and that revisions will, be skewed to the upside.
So right now what we're seeing is a broad sigh of relief in markets with some cheering in the bonds, where you're seeing basically people writing off the Fed, raising rates again, and saying you are seeing the soft landing. You are seeing the disinflation, you can call it immaculate or whatever else, that a lot of people were waiting for. What in this data can you point to say they're wrong?
Well, it's not much. You could make the argument, I think, that the downward movement in used cars will probably only build over the rest of the summer. We do know that wholesale auction prices continue to come down. And thus far, we've only seen a very modest decline in used car prices. So there may be some more pass through there. So I do think that there's probably a little bit more disinflation in the pipeline. But again, I think the reacceleration story for inflation, it's really about, in my view, is the economy growing above trend or not? And I think the economy is growing above trend. I don't think the Fed has done enough. And I think the Fed is kind of enamored with this soft landing view. They're almost wish casting this outlook. And I do think that there is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up, sometime next year. We do know that home prices are rising. While the relationship between home prices and rents is very tenuous in the short run, I mean, ultimately, the asset market effect is what drives rents. I mean, landlords don't charge. They want to extract more from tenants when the underlying value of the asset that they're putting on the market is going up in price. And commodity prices, oil is at year-to-date highs, more or less, with everyone concerned about China and Europe. I suspect these economies probably won't get much worse than they are now. I mean, that would be my baseline expectation. And there's probably, in other words, there's more room for oil to go up. And that's going to have very mechanical impacts on not just headline inflation, but parts of core inflation as well.
I've been looking at the pricing in markets of Fed policy and where people are settling out. And they're now pricing in cuts at the first couple of months of next year. And I'm wondering, from your vantage point, Neil, how disruptive it would be if suddenly that market complacency is challenged by the idea of stickier inflation, reaccelerating inflation that wouldn't even cause another Fed rate hike, but just wouldn't necessarily lead to those cuts.
Yeah, I mean, it depends, right? Because if it's a stronger economy and stronger growth expectations that's making the market price out those cuts, I mean, that could be in an environment where equity markets could potentially work, right? So you see higher interest rates and that hurts, but you'd expect earnings and expected earnings expectations to go up, so that could be okay. But I do think, to me, it comes down to something very, very basic, right? The Fed began hiking in March of last year. And since then, what do they have to show for it, really? Powell talked about pain being necessary or likely. We've seen the unemployment rate actually tick down since then. GDP is growing above trend. Broader financial market conditions are as easy now as they were then, maybe if not easier. All deference to the Fed's new financial conditions framework. That number, when it was published, showed financial markets being a headwinds. Now that right. has basically gone to zero. So what have they actually done? So I think it comes down to something very basic. Either you think the labor markets are a conduit for inflation, or you don't. And I think what we're seeing now is basically tight labor markets, a lift to real wages and I think ultimately people will go out and spend more money, booming household demand, and I think that'll keep prices in the aggregate stickier for longer.
In the aggregate, Neil Dutta, thank you so much with Renaissance Macro. We get clarity now on an August Thursday with David Kelly, Chief Global Strategist, JPMorgan Asset Management. He has been definitive over the decades of the holistic picture. David, I do want to get to your stunning call on jobs, but let's leave that aside right now. Do we have disinflation in America?
Yes, we've sort of got gathering disinflation in America. We've got the numbers this morning were close to what we thought, but it's nice to see the sort of the core services part of inflation coming down. But what I think I'm most interested in is it's not actually the numbers, it's forecasting the numbers. Because when you're trying to forecast these numbers, you realize, okay, new car prices have basically been flat or down since the start of the year. And we're still seeing these huge increases in auto insurance and auto repair costs, but that's got to break. And same thing with shelter costs. Shelter is about 90% of the increase in CPI at this stage, but we know the rents have stopped rising. We know that there's a rising vacancy rate for apartments. So what we can see is the promise of future disinflation in these numbers, and we're really trying to forecast these numbers. And that's why I'm so convinced that inflation is going to get down to 2% on its own, with or without any help from the Fed.
In your summed statement, and you and I have talked about this over many years, including with Bob Goodman years ago, there's an underestimation of the x-axis. Are we underplaying in our what's going to happen next quarter, what's going to happen in Jackson Hole, what's going to happen to the meeting? Do we need to extend out our study a year out, or dare I say 2 years out, to get to a successful disinflation?
Well, for investing, you always should, because equity investing, and most of your viewers are interested in the stock market. It shouldn't be about the next year anyway. But yes, I think particularly this time around, I think that's the case, because what we know with inflation is it's very symmetric. It actually looks like the Eiffel Tower. It goes up and comes down in exactly that pattern. We saw it in the 1970s. We're seeing it again now, 40 years later. But it takes a little while to come down. And it's because of lags in things like transportation services, and particularly owner's equivalent rent. And so as we track this thing out, it's going to hit 2 on CPI and on core CPI by late next year. And that's the track it's on. So I think you have to wait for that to play out. And then you realize that, okay, where does that leave us? That leaves us in a low inflation, slow growth economy. I think the Federal Reserve will be cutting interest rates obviously faster if we end up in recession. But I think you have to sort of look out beyond the volatility of inflation that we've seen in the last 2 years to realize that we're headed for a place of slow growth, which looks quite like a decade ago. I think that's really sort of a return to where we were 10 years ago.
If that's the case, why wouldn't you take a look at where markets are positioned and just load the boat with 30-year treasuries and say, everyone's wrong. They think that inflation could get unmoored if the Fed is less aggressive. I don't.
I wouldn't back up the truck, because I think there are better opportunities in markets than 30-year treasuries. I mean, I do think that the bond market overall is better priced than it's been for many, many years. And I think there is a one-time capital gain there. As rates come down, as people realize the Federal Reserve is going to have to cut rates. Because sooner or later, this economy will stumble. And a 4% 10-year Treasury yield will turn to a 3% Treasury yield or a 2% Treasury yield, and people make a capital gain. But I think there are better long-term capital gains to be made still in the equity market. Right. But I wouldn't be underweight fixed income right now. And within fixed income, I'd be definitely long duration and short credit. I don't think you're getting paid for taking credit risks. You are getting paid for taking duration risks.
Dr. Kelly, I've got to do this. It's too important. Jason Furman of Harvard just comes out with the mathematics on the annualized view. 12-month annualized, 4.7% core. 6 months, the view is 4.1%, a lesser disinflation. 3 months, which is what I look at, 3.1%. David Kelly, the 1-month annualized core CPI is 1.9%. Can you go short-termism and look at those 1 and 3 month statistics? Are they a valid tool to gauge disinflation?
I don't think so, looking at the CPI index, because what's really going on is you've got these weird categories in owner's equivalent rent, actual rents, and transportation services. And I think you just have to track what that's doing. I agree with the general proposition that core services inflation and inflation in general is fading here. I do not think it's getting pushed up by wages. I do think it's getting pulled down by competition and by increased inventories. So I agree with the result, but I think the short-term view is really being affected by the way the government measures these things.
David, thank you so much. David Kelly with JPMorgan. This is a joy, after Michael Nathanson yesterday and talking to Rich Greenfield from time to time, to speak to Jessica Reif Ehrlich, senior media entertainment analyst at Bank of America. Is an honor on this important day for Disney. Jessica, I don't want to talk numbers today. I don't want to talk ratios. Iger wakes up. I believe he puts on his pants one leg at a time. He goes into the office or takes breakfast at some place with avocado this or a glass of pure water. Who does he speak to within Disney about the urgency of a true restructure? Who's he actually talking to?
I think that is a great question, because there does seem to be a lack of confidence within the company, given the exodus of executives over the years. And so reportedly bringing back Kevin Mayer and even Tom Staggs should, give Bob Iger somebody with experience to kind of bounce things off of.
But the issue, Jessica, and you've lived this. I mean, you used to go in and Gordon Crawford would shake at Capital Guardian Trust because Jessica was showing up to give him wisdom on this. There was a business model. You made a movie, you made 4 movies for $100 million, and one of them hit big and everybody was happy. That model's been destroyed. What's the Jessica Reif Ehrlich streaming model that will provide cash flow and profit?
Look, I think they're taking the right steps. I've heard you guys speak about the price increase, which is hefty. There's a 27% price increase for the subscription-only tier at Disney Plus and a 20% price increase for Hulu. Again, subscription-only. The advertising tier is not being touched because the ARPU is higher with the combination of subscription and advertising. So they're kind of forcing consumers into the lower-priced advertising-supported tier. So that should help the bottom line. They did say that costs are ahead of expectations, so they'll have more than $5.5 billion in total costs being taken out of the company. A lot of that is streaming. So it's content, it's marketing, overhead, et cetera, SG&A, et cetera. So they're focusing on that. On the content side, they do need to improve, no question about it. And Bob Iger said last night this is his primary focus.
Well, primary focus in order to grow the platform or in order to prepare it for some sort of spin-off or sale to someone else?
In either case, whether it's keeping it internally or selling or spinning, they need to improve the content. And it's, the content on the platform has to be improved. He said in the past that it's been getting tired. They have too many, there's just, everyone's getting distracted. And obviously, the one place where they've really missed is in film over the last, couple of years. And this is his primary focus. They have to fix that film division.
So this sounded like a Bob Iger in retreat, defensive, not really aggressive and offensive, not planning out some sort of expansion kind of plan, but rather really not pushing back against the suggestion of a sale to Apple, either in some of the parts or in a large sum. And you're looking at a situation where people are questioning what the value of the company is beyond the parks. Do you think that it is valid to really characterize this as Disney in defense?
Well, look, they are clearly challenged from multiple areas. They have secular challenges with the pay TV universe in decline, as do all traditional media companies. There are also cyclical challenges, which all companies are facing. But they have incredible assets. They have incredible branded, unique IP. And so this is, so they're dealing from a position of a challenged position on one hand and a position of strength on the other. And it does feel like, yes, there's some defensiveness because they have to fix what's wrong, and there's a lot that's wrong, but he's also dealing with each piece of it. So whether it's leveraging the ESPN name, with the deal with Penn, or, focusing on different parts of the business, they're with costs are growing the subs. On sub numbers, I know you guys have mentioned that they lost subs, but a lot of the subs are 50-cent subs in India that don't financially contribute.
All right, Jessica, just to give me a 3-year vision on who's going to win at streaming on a buy, hold, sell basis. Who's your winner out 3 years on the streaming wars?
Well, obviously, Netflix is doing incredibly well and in a great position. We also think Warner Brothers Discovery with Max, which is really just at the very, very beginning stages, is in a phenomenal position, given their extensive. They don't just have the biggest library, they have probably the best library in the industry. And I think you guys have been a little tough on Disney this morning because if you add Disney Plus with Hulu, with ESPN Plus, they are well over 200 million subs. So they have a lot going on. But look, there's a lot to fix. And I absolutely agree with that. And it does seem like they're taking many of the steps that are necessary to fix this platform.
And Jessica, we're being tough because our subs aren't 50 cents. They're like $80-something a month. Jessica, thank you. Jessica Reif Ehrlich of Bank of America. Appreciate it. Okay.
Henrietta Treyz, Economic Policy Director, Research at Veda Partners, joins us right now. We talked to Kim Wallace earlier, which is great because you got legit international economics there. And with Henrietta Treyz, you've got piercing domestic policy analysis. Excuse me. Henrietta, what do the Democrats do on Capitol Hill to advance Bidenomics?
Well, first of all, let me just say I wish I'd dressed better for this segment because I am just beyond at Hermes, I think we're calling it now. So what are the Democrats doing to advance Bidenomics? I mean, I think right now what you're seeing is them canvassing across the country and really watching to see, most importantly, who is coming out in the Republican Party on the Senate candidate side and how they can run an economic agenda against them. So far, it's turning out to be pretty easy, and they don't even really have to focus on economics yet, as the votes in Ohio earlier this week showed. They can talk about abortion issues and get the turnout to be through the roof. They can run against Carrie Lake, it looks like, in Arizona, which is going to be sort of a Trump versus Biden and sort of mainstream politics. So the Bidenomics message is something they're trying to get out there, but they haven't had to really yet.
When you're wearing your Hermes in all the bars of Capital City and you're getting pulsed up here for the debates, the primaries, the election, Henrietta Treyz, the phrase, "it's the economy, stupid," I've never agreed with. Is it the culture war, stupid? Is that really where we're heading?
You know what it is? It's abortion, stupid. Do not come for abortion. I mean, Roe v. Wade and the Dobbs decision was the worst thing Republicans could ever have done. They woke up a beast. It is all age brackets. It is a turnout machine, and they're losing hand over foot. And I don't see any way that that's going to change, especially since Republicans keep poking the bear. So I think that's really the message. It's not the economy. It's abortion.
That message on the national stage isn't going down well. What about in the primaries, Henrietta? What do you expect to hear in the debates later this month?
Well, the debates this month are obviously all going to be on the Republican side. And I think Ron DeSantis is the one that every candidate is going to try to beat because Trump may or may not show up. If Trump is not on the the dais for those debates, you're going to see Ron DeSantis just get slammed by every single candidate, from Nikki Haley to Tim Scott, on down to Mike Pence and Chris Christie. They will bring up Trump occasionally, but the person to beat will be Ron DeSantis. He's already tanking in the polls. He was at 30% at the beginning of this year. Now he's below 15. That is a death spiral. Campaign shakeups, et cetera. I have a friend ask if we're going to have a watch party for the November 8th DeSantis Newsom debate. And the question is more, is he still going to be one of the front runners in the race after these campaigns and after the debates at the primary side? I mean, their position on abortion is just as far to the right as you can get, and they just drive each other further, which alienates the entire general election base.
So if it isn't Ron DeSantis, who is the front runner? Is it going to be Tim Scott? Is it going to be someone who's not even thrown their hat in the ring yet, like Glenn Youngkin?
I think so, Lisa. I mean, there is a deadline of November 16th to get on the ballot in Nevada. And I think that that's a key deadline to look for. I think the money that has gone to Ron DeSantis could easily start flowing to another candidate. I do agree that Tim Scott is the next most likely, but he polls at 3%. So really, Glenn Youngkin or any of the other governors could step in. Sununu, I know you is a frequent guest on your show, and I'd be interested to see whether or not he decides to change his mind in the wake of the 4 indictments, or 3 now, but 4 to be coming against Trump, and DeSantis maybe not being the second runner-up.
There's been a belief construct, Henrietta, which you have studied for years, going way, way back, that the United States of America will always grow itself out of its debt troubles. Is that shaken right now? Is that foundational belief shaken?
I don't think so, because the appetite globally for debt just keeps expanding. And I don't think that's a U.S. specific problem. And perhaps to be more honest about my answer, Tom, I don't see any lawmakers sincerely putting in the effort to reduce the deficit. So I don't think that debt is something that they are really going to look in the mirror and say, hey, maybe we shouldn't extend the 2017 tax cuts for individuals beyond 2026. They're going to. They always do. We saw that movie in 2010 and again in 2012. It's going to wrap up the deficit substantially, $2 trillion just for those tax provisions. And I don't see any real conversation until we get into a maybe untenable place with Social Security.
Henrietta, I want to finish on China, if we can. The Biden administration, as you know, have put out their outbound investment order. The president has signed that. Here's the question for me. It's super narrow. China says we're disappointed. I'm trying to work out if it's just to say, A, we're doing something, and B, we're disappointed, but actually nothing really changes here. Is this just for public consumption, or is this meaningful?
You know, it's such an interesting question. And I was actually thinking about this before I came on the air. Last week, Lisa, and y'all, we were talking about the Fitch downgrade. And one of the questions you asked was, is the business community responding to what Congress is doing, what the administration is doing on the debt, to bring in Tom's question? And what's interesting about this investment executive order is that the business community is already ahead of it. If y'all had a great chart yesterday, I guess, on venture capital in China and how it's declined since the COVID era. It is a precipitous rise after 2019 and an immediate fall. And that's on the venture capital side, obviously with Sequoia, but you probably get in the same kind of thing in the data on business side as well, where you have the Russia sanctions, export control restrictions. To sort of get to that question, the business community might not be afraid of Congress and what it's legislating, and maybe not this executive order, but for damn sure they're focused on the Bureau of Industry and Security and the Treasury and the IRS and the efforts that they're going through to put sanctions, export control restrictions, investments restrictions. The entity list is going to be updated. Those are real, tangible meat and potatoes things that businesses have to respond to. And I think they are working, maybe just better than the timing on an EO.
Henrietta, thank you. Henrietta Treyz there of Veda Partners.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.